Imagine a China Internet ETF trading at just $36.50 per share that holds Alibaba, Tencent, and PDD Holdings, the Chinese equivalents of Amazon, Facebook, and Google combined, trading at valuations 60 to 70% below their American counterparts. An ETF that's captured 54% year-over-year growth, holds $8.71 billion in assets under management, and provides exposure to 1.09 billion Chinese internet users, representing a $2.1 trillion e-commerce market that's twice the size of the United States. This ETF has crashed from its 52-week high of $43.37, falling 16% as Wall Street indiscriminately punished Chinese tech stocks despite explosive revenue growth and expanding margins. But beneath the volatility lies an extraordinary opportunity. China's internet penetration is only 77% versus 93% in the US, meaning hundreds of millions of new users are still coming online. Online shopping accounts for 32% of retail purchases in China versus just 15% in the US. Tech giants like Microsoft, Google, and Amazon are building AI data centers in Asia, and Chinese AI company DeepSeek just shocked the world by challenging NVIDIA's chip dominance. Legendary investor David Tepper recently increased his Appaloosa management holdings in KWB by 21.5%, betting big on China's tech resurgence. With top holdings Alibaba at 11.3%, Tencent at 10.6%, and PDD at 7.5%, representing nearly 30% of the ETF. Could this beaten-down China internet basket deliver extraordinary returns as the world's second-largest economy accelerates its digital transformation? Before I reveal which China internet ETF I'm analyzing, welcome to Smart Investing. I uncover undervalued international ETFs and global technology plays with massive growth potential Wall Street overlooks. If you want opportunities in emerging markets and global tech, hit that like button and subscribe. Now let me show you this China Internet comeback play. The ETF I'm analyzing today is CraneShares CSI China Internet ETF, trading on NYSE Arca under ticker symbol KWB. KWB is a pure-play China Internet ETF providing access to Chinese Internet companies that offer similar services as Google, Facebook, Amazon, and eBay. Founded in 2013 by CraneShares, KWB tracks the CSI Overseas China Internet Index consisting of China-based companies whose primary businesses are focused on Internet and Internet-related technology. The ETF holds 33 positions with top 10 holdings accounting for 60% of assets. It includes publicly traded securities on Hong Kong Stock Exchange, NASDAQ, or NYSE, with expense ratio of 0.69%. Currently trading at $36.50, KWB represents a leveraged play on China's internet sector recovery and digital economy expansion. While conservative near-term estimates suggest moderate growth, long-term potential is extraordinary. The transformational scenario: if China's economy continues reopening momentum, regulatory environment remains supportive, domestic consumption accelerates through middle-class expansion, AI and cloud computing adoption explodes, and geopolitical tensions ease with favorable trade agreements, KWB could reach $70 to $90 over 3 to 5 years, representing 92% to 147% gains. In an optimistic scenario where Chinese tech valuations normalize toward US peers, regulatory headwinds fully clear, and major holdings like Alibaba and Tencent recapture their 2021 market positions, targets of $103 plus become achievable over 5 to 7 years, representing 182% upside from current levels. The risk scenario: US-China tensions escalate with new tariffs, Chinese economic growth disappoints, regulatory crackdowns intensify, or tech giants face margin compression. KWB could decline to $28 to $32, representing 12 to 23% downside. December 2025 saw KWB cross-listed on Hong Kong Stock Exchange in partnership with ICBC UBS International, providing Asian investors direct access and increasing trading liquidity across time zones. November 2025 brought DeepSeek's shocking emergence as Chinese AI company challenging NVIDIA's dominance, validating China's tech innovation capabilities and boosting sector sentiment. David Tepper's Appaloosa management increased KWB holdings by 21.5% in Q4 2024, signaling institutional confidence in China tech recovery. China's November 2025 economic data showed consumer inflation hitting near two-year high with CPI rising 0.6% year-over-year, indicating improving domestic demand, critical for internet consumption stocks. Top holdings Alibaba, Tencent, and PDD reported strong Q3 2024 earnings with Alibaba growing cloud revenue 7%, Tencent gaming revenue up 11%, and PDD revenues surging 44% year-over-year. KWB presents compelling opportunity to capitalize on China's massive digital economy at deeply discounted valuations compared to US tech peers. The valuation gap is extraordinary. KWB trades at P/E ratio of 18.59 versus Nasdaq's QQQ at 35+. Alibaba trades at 12x forward earnings versus Amazon's 42x. Tencent at 18x versus Meta's 28x. This 50 to 60% discount provides massive margin of safety. The market size opportunity is massive. China's 1.09 billion internet users represent world's largest digital market. Retail web sales reached $2.1 trillion versus $1.1 trillion in US. With only 77% internet penetration versus US 93%, hundreds of millions of new users are coming online. Online shopping represents 32% of Chinese retail versus 15% in US, demonstrating superior digital adoption. The top holdings dominate Asia's digital economy. Alibaba controls e-commerce and cloud infrastructure. Tencent's WeChat super app has 1.3 billion users controlling payments, gaming, and social media. PDD's Pinduoduo and international Temu platform is disrupting global e-commerce with 44% revenue growth. The regulatory environment is stabilizing. After 2021 to 2022 crackdowns, Chinese government shifted to supporting tech sector growth. Recent stimulus measures, property market support, and AI development initiatives signal pro-growth stance. There you have it, KWB, trading at $36.50 with potential long-term target of $103 plus, holding $8.71 billion AUM, top 3 holdings representing 30% with Alibaba, Tencent, PDD at 60 to 70% discounts to US peers, 1.09 billion internet users, and $2.1 trillion e-commerce market. With David Tepper increasing holdings 21.5% and China's digital economy accelerating, this could be the ultimate contrarian international tech play. What's your take? Is China tech the opportunity of the decade or too risky given geopolitical tensions? Drop your thoughts below. If you found this valuable, hit that like button and subscribe to Smart Investing. Remember, this is educational content, not financial advice. Thanks for watching.